Hey, everybody, welcome to the November 2025 market update. Let's go ahead and jump right in as we look at our five county area. Again, as always, it's Wake, Durham, Johnston, Orange, and Chatham counties that we're taking a look at here. And new listings year over year were up 1.6%. 2,063 new listings taken in that five county area. So that's a little bit of a slowdown in terms of new listings that were hitting the market year over year. But if we look year to date, we're still up over 13% in terms of new listings. So that's really healthy. If we want buyers to buy houses, we need to have houses for them to buy. So we need to see those new listings continuing to tick up as we go into 2026. We still have sufficient runway to have more new listings, increases in new listings year over year into 2026. Our market can sustain that inventory. Closed sales actually reversed trend just slightly in November. They were down 0.7%, had just over 1,900 closings in November. Now, there could be any number of reasons. We, of course, had the government shutdown. That could have had an impact. This is such a small number. I would say it's materially insignificant. If we look year to date, we're still up 2.4% in terms of closed transactions. Median sale price up slightly year over year, 1.1%. And year to date, we're still under 1% increase. So again, that's good. What we're hoping to see, you've heard me talk about for a couple of years now, is that what we'd really like to see is kind of flat pricing, either up 1%, down 1%, somewhere in that range is probably going to prove to be a healthy place for us to be. So if we're at this point next year, looking back, if we see the same kind of price growth, I think we can all be really happy with that if prices are holding steady, not seeing significant drops or significant spikes. Looking at total showings, they were up 1.7%. Again, a little bit less year over year. It was still an increase, but a smaller increase than we've seen in recent months. But still like the idea that showing activity is up. We want to see that, of course, continue into 2026. And that has a lot to do with new listings. So as new listings, if that remains, we continue seeing increases. There are more homes for buyers to get out there and see. So we like to see that showing activity hold strong. Now, if we look at point in time inventory, it was up 27.5% year over year. That's just over 7,100 homes on the market at this point in time at which that is checked every month. Now, that is a headline number that somebody could look at and say, wow, inventory is spiking. But keep in mind, if we go back and look at March or April of this year, inventory was up year over year 50% or more. So the fact that we're at 27.5% here in November, that's really a good number. We had so much room for inventory. And as you'll see in just a moment, we still have more room to go before we even get close to considering having too much inventory. Month supply of inventory, 3.7 months. Back in November of last year, it was 2.9. So just keep that in mind. The month supply of inventory basically says if no new homes came on the market, then at the rate that buyers are buying homes, it would take 3.7 months to sell all of the current inventory. That's actually really healthy. Most people would consider somewhere between 4 to 6 months of inventory as a balanced market. So no crisis here, a really healthy number. But now let's look back at November of 2019. As you know, I like to say or compare where we are currently to the last pre-COVID market. So kind of quote normal market. Inventory back in 2019 was at 8,079. So that's why you can see we still have a gap of almost 1,000 or over 1,000 homes, or not over, almost 1,000 homes before even getting back to the inventory levels of 2019. And for real estate agents who were selling back then, you will remember that in 2019, it felt like we had no inventory. I remember talking to agents that would have these lists of buyers saying, well, if I could just find a house for them, they're ready to buy a house today. There just wasn't enough to look at. So that's why I say we have plenty of runway left before we're getting into any kind of elevated inventory levels. The month supply back then was at 3 months, and the median sale price was $300,000. So again, if we look up here today, median sale price is basically $455,000. So big difference there. When we apply this normal appreciation, so if this is the first time you're watching one of my market update videos, I like to apply a 5.5% appreciation to where we were back in 2019 to say, where would we have been today without the COVID spike? If we had just had straight line 5.5% appreciation, which by the way is really healthy. We have a very desirable market, one of the best markets in the country. So our typical appreciation rates in kind of quote normal times is going to be maybe a little bit higher than it might be in other markets. So let's just say we had 5.5% appreciation since November of 2019. Then today's prices would be at 413,652. As you can see, we're at 455. So if prices stay flat for the next 2 years, that then will get us to where prices are today. And so that means 2 years from now, if prices stay flat between now and then, consumers would view that price, that price would feel, this 455, that would feel normal based on the amount of time that has passed and typical appreciation rates. So that's why I say we still have lots of runway for prices to stay muted, either up or down 1%, kind of in that flat range. And if we can see that stay for the next 1 or 2 years, that goes a long way in terms of helping affordability and just helping the way consumers feel about home prices. Looking back at new listings, we had 2,500 new listings hitting the market back in 2019. Again, we were just up over 2,000 this month. So fewer listings hitting the market. And then closed sales, we had almost 2,700. This year, this November, we only had 1,900. So let's look at the year-to-date numbers, especially with these closed sales. Year-to-date back in 2019, we were at over 32,000 closings for the year. This year, we're under 25,000. So that's where you can see just we are so short on the number of transactions. We have so much room to go. And yet, of course, our population is higher today than it was 6 years ago. Hopefully, we will continue to see this trend of more listings coming on, which then gives buyers opportunities with mortgage rates moderating. All of this should help to create more transactions in 2026. And we are seeing that trend. So let's just look at inventory levels real quick so you can see just how 2025 shapes up. This green line represents 2025. The blue line up top is 2019, and the orange line here at the bottom is 2024. So we can see that we are still below the 2019 levels, but our trend is normal. So back in 2024 last year, we had this kind of stutter start here. Where inventory remained really low, in the early parts of the year, we finally started to kind of pick up. You can see how flat this was last year. 2025, we really started off on the right track. We were starting to get more inventory into the market. We kind of peaked in this, July timeframe, which is pretty typical. And now we're starting to see this downward trend, which should bottom out in December. And then we will typically see January have an increase in inventory again. So, of course, we'll be keeping an eye on that. All right, let's look at new listings. So this is a cumulative look at new listings hitting the market throughout the year. The green bar here on the right represents 2025. And if you're looking at your computer, you can see a percentage at the top of that green bar. What that represents is how many percentage-wise of more new listings we would need to catch up to 2019. So we would need 9.4% more listings year to date through November in order to catch up to where we were in 2019. So that's not off too bad when you consider how far off we are on closed transactions. We're not too far off on new listings. So if we can keep getting those new listings into the market, that should help bring things up in terms of closed transactions, which starts to create a healthier market. All right. So then if we talk about closed sales, this is just year over year. So this is each month. You can see we broke trend. As I talked about in November, we had fewer closed sales. We had outpaced in terms of monthly transactions. We had outpaced 2024 ever since May. Okay, so the first 4 months, or February, March, and April, we were below pace on 2024. But in May, we actually surpassed the number of transactions in 2025 over last year. And that trend continued all the way until November, when we were just slightly below. Again, some more macroeconomic factors that may have contributed to that. But as you'll see here, year to date, we are still ahead. We surpassed 2024 in July and have continued that trend. Now, what you see with this percentage here is that we would need 30.6% more closings to catch up to where we were in 2019. So we are still really far off from those levels. I don't see any reason why we would catch up to those levels in 2026. Probably not in 2027. Of course, that's so far off. It's really difficult to predict that. But what we want to see is this bar start to close the gap here. And as long as we're moving in that direction, as long as we're seeing more closed transactions in 2026 than we saw in 2025, that will be really a healthy signal for our market. So we're going to continue watching that closely, and I'll continue reporting those numbers for you. Now, one metric that I like to look here is this new listings to closings ratio. This doesn't tell you necessarily how healthy the market is, but this does tell you what does it feel like for sellers. So what I've done this month is I've created a common denominator here so that we can really see what we're talking about in a relative basis. So in 2025, right now, year to date, our ratio is 1.44. In 2024, we ended at 1.26. So what does that actually mean? Well, it means in order to sell 20 homes, last year, we needed to take 25 listings. So for every 25 listings we took, 5 of them were not going to sell. This year, we are at a pace of needing to take 28 listings in order to sell 20 homes. So when I say this ratio talks to what does it feel like for sellers, because 28 houses get listed, 8 of those sellers are unhappy at the end of that process. This is, again, why more real estate agents are having to take listings off the market for the first time in their career. Sellers are getting frustrated because maybe the house has been on the market for 30 or 60 days and hasn't sold. But as we looked at previously with 3.7 months of inventory, homes really need to have a 90-plus day marketing period, exposure period, in order to really understand how the market is reacting. Now, that doesn't mean that they don't need price reductions during that time. We are trying to find the right price for every listing that goes on the market. Sometimes that includes price reductions. But if we look at where we are with this ratio, this is back to like a 2011, 2012 timeframe. And so homes did take longer to sell back then. Very normal. But you can understand that for the last decade, since 2014, so really 2013, so for more than a decade, we've seen the houses just sell so quickly, all the way down to the bottom here in 2021, where basically every single home that came on the market sold. So now we're at a place where a larger percentage of homes aren't going to sell because they haven't found that right price, or they weren't prepared correctly for the market to where buyers were going to be interested in making an offer. When you have fewer buyers making offers, you have to be the best price and the best condition on the market. And so we're just finding sellers trying to find that balance there to create that experience. So just something to keep an eye on. Again, as I've been saying, I think we'll end the year right at about 1.4, which is this 28 houses listed to sell 20 of them ratio. So just explains a little bit why sellers are experiencing what they're experiencing right now. All right, last thing I want to look at here, which is really the best news of all of this. Pretty kind of moderate data in November otherwise. But what we saw in November was affordability in our 5-county area going up to 86. This is the highest it's been in over 3 years. This is up almost 18% over last year and up over 20% from 2023. I talked about how last month in October, the 76 seemed kind of like a muted number because it was barely up from October of 2024. But when we looked back to October of 2023, we saw that we actually saw more than a 10% increase in affordability from 2 years ago. So that was a really positive signal. And we saw that continue in November. So this has to do with lowering mortgage rates, moderating prices, wage growth. All of these factors go into calculating this home affordability rate. So of course, this is just one data point. We need to see what the trend looks like moving forward. But I was already feeling better about it in October, certainly feeling good about this in November, as we hope to find a journey back to a 100 affordability, meaning that the median income can afford the median priced home in that market. That would be a 100. We've been under 100 since March of 2022. Back in 2019, we were soaring way over 100. So probably won't get back to that kind of affordability level anytime soon, but this is a really great number for us to end this report on. So hopefully this information has been helpful for you. Looking forward to analyzing December and the full year picture of 2025 as we get ready to enter the 2026 market. All right, until next time, take care.